This is Jane. She's got a great business, but is finding it really hard to raise Series A funding. New investors think the price is too high, and yet her existing business angel won't settle for anything less. She's stuck in a funding stalemate, and her business is at risk of becoming a zombie. To help everybody think about raising a seed investment the right way, let's go back in time and see what Jane did wrong and what are the common pitfalls. 2 years ago, Jane had a great business idea, and she managed to raise £500,000 at a £5 million valuation from a group of business angels. This gave her a post-money valuation of £5.5 million. That's to say, she had a £5 million potential business and £500,000 in the bank, combined adding up to £5.5 million. The angels now own 9% of the business. Her new angel friend had invested enough money to give her 12 months of runway to hopefully do a bigger raise from a venture capital firm or VC firm around a year later. This was the first mistake she made. She was focused on time and runway rather than making sure she raised enough money to achieve product market fit, often shortened to PMF. Why was this important? Firstly, proving her product has value to customers is essential to VC investors to see, as well as demonstrating an ability to hit objectives. So, after 12 months, she needed some more money, and so asked the angel to help her again. She knew she was too early for a larger VC investment. The angel agreed and said he'd give her more money until she had proved her concept and could reach Series A funding. And because the company had survived a year and had some new learnings, they agreed that the old post-money valuation of £5.5 million had probably grown, and £6 million felt like a fair valuation. The angel gave her another £500,000, taking the new post-money valuation to £6.5 million. That's to say, she had a £5 million potential business, which is now being valued as a £6 million potential business, and a new £500,000 in the bank. Combined, adding up to £6.5 million. The angel now owns 17% of the business. Jane then hired more people and tried to go faster, but this meant she needed more money again only 6 months later. It also meant that her costs had grown quickly, but her revenue was still behind plan. This time, the angel begrudgingly agreed to invest a further £250,000, this time raised at a £7 million valuation. Giving a new post-money valuation of £7.25 million, the angel now owns 20% of the business. Another year passes, and that's where we find Jane today. Jane thinks she has a business that is worth more than £8 million. The angel needs it to be worth much more than this too, as they anchored their view based on the last funding round of £7.25 million post-money, and want to make a return on their investment. The angel has a minimum required return to make all the risk he's taken worth it. He's invested £1.25 million and owns 20.23% of the business. For the risk he's taken, he wants to make twice his money back, at least. For that to happen, the business now needs to be worth at least £12.4 million. But the new potential investor doesn't see it the same way. He highlights that the business is still not hitting its objectives and is only just beginning to achieve product market fit. The business has been focused on raising money and staying alive rather than on delivering very clear product market fit milestones. In an effort to move faster, she has also grown her cost base too much, which also isn't attractive to a new investor. And so, to an outside investor, this still looks very similar to the original £5 million potential business. Albeit time has passed and Jane has learnt a whole lot of interesting and important things about her clients, product and market. First, we had a potential business worth £5 million based on hope value. Then £1.25 million was invested over 3 years, and this was all spent by Jane. The business learned a lot over that time, but still isn't a real business making sustainable revenue. It does, however, have a lot of learnings. So we have an original potential business of £5 million plus some learnings. He thinks £6 million is a fair valuation. We reach a funding stalemate. The angel and Jane now can't accept a down round, but the business is overvalued. So the angel angrily agrees to continue to drip feed the company with money rather than accept a lower valuation. The business becomes a zombie and everyone is unhappy. Jane should make sure she starts with enough money for her to achieve product market fit milestones and then manage her spend rate accordingly. Rather than try and scrape by on $500,000, she should have agreed a larger raise of $1.25 million at the original $5 million valuation and agreed it with staged payments against clear PMF milestones rather than time stayed alive. Stage 1 might be £250,000 to get to proof of concept with clear metrics and measurement capability. The next stage would then be released, perhaps £350,000 to optimize those metrics for product market fit, making sure that customer activation and retention are dramatically improving such that the product can be sold sustainably. A third milestone of funding might then be a further £650,000 to drive growth. As all of this was done at a pre-agreed valuation of £5 million, the Angel Group owns 22.8% of the business, not 20.23% as with the previous example. In this situation, you may worry that Jane has had to take on more dilution up front by agreeing the full £1.25 million at a £5 million valuation, but she has a much better and more valuable business as a result. Not only is the business better having achieved product market fit, but the angel is happier with a lower valuation in order to deliver their required return and allow the business to move to a more specialist and experienced investor in Jane's space. The VC is excited about the value they can add to this business for its next chapter, and Jane is happy as she has the funding and support she needs to create a fantastic scale-up business. Good luck, Jane. You're going to grow a fantastic business